Good day, Junior Tikkies. I'm Mrs. Brimacombe. We are going to look at adjustments where the focus is going to be on interest expense and interest income. Interest on loan is an expense to the business. It's the cost of financing the business. So interest on loan can either be capitalized, which means it's added to the loan account, or interest is not capitalized. It's important to understand the difference. If we look at if interest is not capitalized, as mentioned earlier, interest is an expense, which means that if we need to pay our interest, interest on loan will be debited, account credited, bank. But if interest is still outstanding at the end of the accounting period, it means that interest on loan will still be debited, but account credited, accrued expense. An accrued expense is a current liability which will form part of your trade and other payables. If we look at if interest is capitalized, as I've mentioned earlier, interest, I need to show what is my expense for this accounting period. If interest is capitalized, it will be added to the loan, which is a liability. If we now look at interest on fixed deposit, interest on fixed deposit is an income and it's generated from investing money into a fixed deposit. Now, if interest is not capitalized, it means that interest on fixed deposit is going to be credited because we need to show our income that we've generated. If that money is received, it will be paid into our bank account. Therefore, bank will be debited. But if interest is still outstanding at the end of the accounting period, it means that I still need to show it as part of my income for this financial year. So interest on fixed deposit will be credited, account debited, accrued income, which is a current asset and which form part of trade and other receivables. If interest is capitalized, it means it's added to the fixed deposit account, which means interest on fixed deposit will be credited, account debited, the fixed deposit. We are going to look now at activity 6, required, prepare the journal entries for the adjustments, post to the general ledger, show the effect on the accounting equation, and now indicate how it will appear in the statement of financial position. So if we now look at the loan, extract from the pre-adjustment trial balance on 30 June 2021. So they provided us with balances and totals. Adjustment number A, the loan statement received from Finland Bank, the balance in the beginning, repayments during the year, interest on loan, question mark, which means we need to solve it, and the balance at the end of the accounting period. Then they say to us, the capital portion of the loan repayment is 1,200 per month for the next 15 years. So first, we need to find out what is the interest. Now, if it's given to you in this way, a loan statement, fill in the information which you've got and find the missing information. If I look at the loan, the balance in the beginning on the 1st of July, 200,000. They provided us with the repayments. You should know if a repayment is made, if we pay off our loan, it means that our liability will decrease. So the total repayment for this accounting period is 37,200. Interest on loan is capitalized, which means it's added to the loan account. Our liability will increase. That is a question mark. We need to solve that. And then they provided us with the balance at the end. So balance brought down means balance carried down. Interest on loan becomes now the balancing figure. Take the debit side, minus the credit side, and that equals my interest. Now, if you're working on the loan statement, I need to work from the bottom to the top. So basically, if I take the balance at the end plus the repayment minus the balance in the beginning, it will give you exactly the same answer. My loan account is going to be credited, account debited, interest on loan. So that is our expense for this accounting period. If you have a look, if you take that 200,000 minus the 37,200, it equals 162,800, which is exactly the same balance in the pre-adjustment trial balance. Why is that? Because the interest was not yet added. In my accounting equation and in my general journal, account debited, interest on loan, account credited, loan, make sure that you write the name of the bank. Effect on the accounting equation, owner's equity minus, because our expense increase, it will have a negative effect, liabilities plus. In my general journal, my narration, what happened? Interest not yet recorded. Interest on loan is an expense, so at the end of the accounting period, this must be closed off to the profit and loss account. So this will show my total interest for this accounting period. Adjustment number B. Provide for outstanding interest. Interest is not capitalized. Interest is calculated at 10% per annum. On 30 December 2021, 70% of the fixed deposit will mature. So now to calculate the interest. They said to me, provide for outstanding interest. So we need to know what was our interest supposed to be for this accounting period. So to calculate that, we need to take the balance in the pre-adjustment trial balance. The fixed deposit is 50,000 and we're going to times that by 10%. From the pre-adjustment trial balance, interest on fixed deposit has a total brought forward of 3,750. So take note, how am I going to approach this? My total interest on fixed deposit for this accounting period is supposed to be 5,000. But the balance or the total brought forward is only 3,750. So take the debit side minus the credit side, that 1,250 is the outstanding interest. And because interest is not capitalized, it means that accrued income is going to be debited. On the accounting equation, in the general journal, account debited, accrued income, account credited, interest on fixed deposit. Effect on the accounting equation, assets plus my income plus means it will have a positive effect on the owner's equity. In the general journal, narration, what happened? Provide for outstanding interest. Accrued income is in the balance sheet account section, so we need to calculate the balance carried down means balance brought down. Now, how will this appear in your statement of financial position, in your balance sheet? If we look at loan, the capital portion on loan repayments is 1,200 per month for the next 15 years. Whatever is paid in the next financial year, that capital balance, it's without interest, must be shown in your current portion of loan. So this means under non-current liabilities, we have 162,800. Interest was capitalized, which means we need to add the interest that we've calculated 26,345. Now, whatever will be paid in the next financial year, that capital payment of the loan, must be subtracted and taken where to? Current portion of loan, which forms part of your current liabilities. So my total non-current is 162,800 plus the interest 26,345 minus the capital portion of loan 14,400. If you add those two together, it equals exactly the same balance in your loan. Take note that current portion of loan can either appear on the face of the balance sheet or it can form part of note number 9, trade and other payables. If we look at the fixed deposit, remember now, the fixed deposit is not capitalized. So, my non-current asset, fixed deposit, Maxibank, the balance is 50,000. But now they said to us, on 30 December 2021, 70% of the fixed deposit will mature. That is within the next 12 months. So the same as with the loan, whatever will mature in the next financial year must be taken out of your non-current and taken to the current. And here again, we're talking about the capital amount, which means now 50,000 times 70% means 55,000 will mature on 30 December 2021. So on our balance sheet, non-current assets, we're going to say 50,000 minus 55,000. It's important to show your calculations. And then that 35,000 must be taken to current assets as part of cash and cash equivalents. If you add the two together, it will equal the 50,000. Thank you very much. Next, we're going to look at activity 7, depreciation and asset disposal. I want to leave you with this quote. You don't have to be great to start, but you have to start to be great. Have a wonderful day.